If I start a coffee shop and I sell it for $11 million, that's unbelievable. It really is. But if you start a software company and you sell it for $11 million, it's like, you're a failure. That is so wrong that we've gotten to that mentality. The companies become the personalities of the founder. And so if the company sells for $11 million and it's seen as a failure in software venture capital, is that person a failure? No.
What's up, everyone? Welcome to another episode of Demo Day, the podcast for entrepreneurs and venture capitalists, where we demystify the culture of joining one of the top accelerators, incubators, and VC funds from around the world. I'm your host, Sean Goldbaden from Coefficient Labs, and on today's show, we'll be interviewing Mark Mullen from Bonfire Ventures. So without further ado, let's get into Demo Day. Mark, thank you so much for joining us on your second episode of Demo Day.
You're Thank you.
Now, for anyone that's listening or watching at home, we have already had Mark on the podcast. So if you want to learn more about his early life, kind of what got him to Bonfire and where he is today, go check out episode 1. But this has been a big year for Bonfire. You guys announced a big $245 million fundraise in February. You've had multiple companies this year on the Inc. 5000 fastest growing. I've seen at least 100 million plus in fundraising across several of your portfolios. So it's been a really big year. And I was curious, with so much growth this year, what part of the growth have you personally been the proudest of?
Well, I think it's pretty amazing that I went from a solo GP to now a team of 11 people. And when you look back, it's kind of like, well, of course we've grown, and we grew almost in step, meaning we have to add people in order to spread the breadth of me and Jim. We can't do it on our own, no matter what you say. I think it's amazing, like some of the big solo GPs, I can't remember his name, in San Francisco, Elad, who just raised $1.5 billion. He's solo GP. I mean, he's an incredible investor, but our model is we do about 10 deals a year, and we get very involved with our companies. We take the board seat. So we have to be available for our companies. We can't just keep investing in companies without making sure we have the time to spend with them. And in order for Jim and I to spread or to grow, we needed to have a team that we trusted and they trusted us in order to grow. So I think that now that we have these 11 people, we can't do it without them. We couldn't have grown without them. We can't grow to the next level without them. And so, you have to really change your mindset going from a solo GP to a one partner, to more partners, to a team, and really allowing and knowing that everybody is out there talking about Bonfire as is one. You have to represent, for a while there, Double M is Mark Mullen. Bonfire was Mark Mullen and Jim Andelman. Right? And that can't sustain. But we now feel like when Jen or Tyler or Brett or anybody else is out there talking about Bonfire, they're talking as if that we would talk about Bonfire. As if we would talk about them, they talk about themselves. So we have a kind of a cohesive strategy. So that's the thing that's pretty amazing. And we have over $1 billion under management. That's also insane. And many days I feel this big. Because if you read the press, if you read the rounds that are happening, if you read the rounds or the funds that guys are raising, if you read what's happening out there, 245? Sometimes.
Wow. Did you ever think that you would feel that way? Because it's always, as you're going up the curve, your first 10 million feels like the biggest, and then the next 50 million, the next 100. Is it funny to you now that having, $240 something million, that it doesn't even have that same feeling,
Totally. It's also similar to you sell a company for $100 million in 2014 and you make 8 times your money. If I sell a company for $100 million today and we make 4 times our money, it's just
wow, it's almost desensitized.
It's so unfair. I had this conversation with the founder last night, and we were talking about the venture model and the mentality around every investment you make has to return the fund. I find that to be ridiculous to actually live up to. and it forces you to make decisions and create hurdles for companies to get through to actually get to that decision. I get it, but it leaves a lot of talented moneymaker people on the sidelines. So if you start a company, if I start a coffee shop and I sell it for $11 million, that's unbelievable. It really is. And that's an American opportunity, right, to do that. But if you start a software company and you sell it for $11 million, it's like, you're a failure. That is so wrong that we've gotten to that mentality, because the companies become the personalities of the founder. That is the founder's personality. And so if the company sells for $11 million and it's seen as a failure in software venture capital, is that person a failure? No, that's not the way it should be. But that's kind of my grind on VC.
I want to come back to that point because I'm curious your perspective on, you mentioned you had this conversation about how the model is going to continue to evolve. And I've definitely heard on other podcasts we've had where that kind of fundamental difference of like what a win looks like to a founder versus what a win looks like to an investor. So I do want to come back to that. Now, like when you think about sort of early days of Bonfire, even like Mole Capital, Double M, like you've had kind of some different chapters of your life. What's like the biggest change that you've seen in yourself when you kind of think about early investor Mark versus where you are today? Has there been any kind of change that you've witnessed or kind of seen in yourself over the last 10 years?
Along the lines that I was just talking about, I invested in probably the two biggest return and dollar wins that I've had were in founders that I invested in the first meeting. And within an hour, okay? So it's not like, hey, from 10 to 11 at 11:01, can I invest in the company? It was in the meeting, decision, I need to invest in this founder, and let's do it. And so then it turned to, my meetings sometimes turn, and people can see this and feel it, and I let it happen openly, from them selling me to me selling them. If I turn to selling you, then I'm interested. I can't do that anymore. We have a I might have the feeling that we should really invest in this founder, but now we have to invest $3 to $4 to $5 million as our first check. We're only going to do these small. We're going to take a board seat. We need to see that. We need to start believing and starting to see where that company's heading to that much larger exit, which I already mentioned is really hard to pinpoint how you get there. All of our investments at the end of the day, and I keep reemphasizing this at our team calls and meetings, is like it all comes down to the founder. And but there's different reasons why we would bet on a founder, different reasons why we would believe in a founder, different reasons why that founder is going to be successful. But you're kind of having to make that decision early, because when you take a long time, I believe, to justify an investment, it's doing all the other work. How big's the market? What's their go-to-market motion? How good is the tech? What do their customers say? That's all important, and we do all that stuff. But if you're not really pushing and excited about those things, it means you're trying to justify the investment by finding out answers to all those other questions, or it means you're trying to justify not being 100% committed to the founder.
How have you had to adjust working with partners in a bigger team? Because in the past you could, like you said, you feel it, you make the investment, you can move very quickly because you don't have to worry about.
That's it. That's 100%. I mean, I was the biggest investor in Mole Capital and Double M, and the only decision maker. So I used to say to the investments that I would make, and some of these guys could tell you, like I used to say DFIU at the end, and I would sign it and say, remember, this is actually my money. This is not some LP that you don't know that's an investor. DFIU means don't fuck it up. Right? And so there was a personality to that conversation. And I as you know, I get engaged with my founders, and a lot of them have become friends, and I know their families now. They get married and they have children. And it's very nice to have those types of relationships, particularly when they've had successful companies. But I have those relationships with unsuccessful companies too. But the point is, there was much more of an ability to act on intuition because there was no one else to talk to. But there was also the risk of acting on intuition, right? Like, I'm like, I don't know. Am I nervous about this investment? So as you move into a team atmosphere, you have to embrace the team concept and the team ideas and different opinions and different personality traits that would perhaps have a different reaction to a founder. And so there's much more discussion. Sometimes it's easier to just make a decision with fewer people. That's just life. For two is easier than three. When you have three, can have two against one. It's always some sort of process. So you have to make those adjustments in order to have a team atmosphere to A, make sure that everybody on the team feels empowered that they can make decisions, and B, make sure everybody on the team knows they have to justify this investment to the team. It's not just your money, your decision, your investment. So that's a clear, opportunity and issue that I've been dealing with. I'm an only child too. So I went from, making decisions on my own to having this team atmosphere. Now I worked in a team before with Bill Daniels so that's not a problem, of course. But to answer your question, making decisions for investments can be a feel thing. And when I say, I think Sean is the greatest founder I've ever met, somebody has to say why. I'm like, I don't know, he wears crazy shirts, and I've always liked his shirts. Well, someone said, well, I don't like, lemon colored shirts. And so then I say, well, actually the tech is great. Or then you have to start actually backing up that intuition. But if I don't have that intuition right away, then it's not even going to be a thing for me. I'm not going to make an investment. That doesn't mean that every intuition I've had about a founder has been right. More right than wrong, but like in any investment or process or decision you make, you have to have confidence and comfort that you're making perhaps the right decision. If you think you're making 100% correct decisions, then you're crazy. If you are worried about making decisions, like it's a stressful thing for you, then you can't be a venture capital investor. Then you'll just overthink every single deal.
When it comes to seeing these early stage founders, I'm curious your perspective on what are the underrated qualities. One of the things that I loved about our first chat was getting to know some of your philosophy around getting to know your founders on a personal level and really trying to understand what's driving them. But I think through those conversations, you start to be able to have some pattern recognition. And I'm curious, what are some of those traits that you look for that it makes you want to lean in right away? Is there any framework or is there any sort of kind of checklist that you have that you're kind of looking for in those early investments?
We could make up things. Everybody has their own styles, et cetera. I, as we've discussed before, try and get very, as much as I can without being nosy, understanding the motivation of the founder. And that entails understanding their differences in their path to where they got to me. It's always like, how did I get to this meeting? How did we get to this meeting? You kind of can read about my life. I did all these things, and then I'm here at Bonfire. But how did you get here? What were the paths, or what were the decisions you made, or what are some of the areas that you focused on that got me the opportunity to meet with you? And also that allows me to start digging into some of their personal life and family. And what I try and really find out is there are some incredibly smart people out there who are very good at the venture process. They're very good at raising money. They're very good at putting a deck together. They're very good at knowing what the venture capital investor wants to hear. And they massage that. And they are very good at finding holes in a problem opportunity set and going after that opportunity. But it really wasn't a passion of theirs. It's just like they're just filling a hole, and they're filling a role. You have to really dig in to understand how somebody got to where they are. So I was talking to a founder the other day. He's one of three children, grew up in Cleveland. Parents were both in the manufacturing business. He got into Northwestern and then was in consulting business for 8 years. And I laid it out for him. I said, I bet you were the first of the family. So yeah, how'd you know that? I'm like, well, and then when you went to Northwestern, you must have been the star of the family. No one can get into Northwestern. So that's incredible that you were able to do that. But you must have had in your mind, your mentality that you wanted to be a consultant because that was looked on as a very high intelligence job that was a great career track. And in fairness, he is Indian, so he's driven by his family directly. And then I said, so after 8 years in consulting, what happened? You could have made $2-3 million a year for the rest of your life and been a partner at McKinsey, but something happened. So that's why I get into like, what happened? And so he's looking at me going, well, and then he starts getting it. He's like, okay, well, this guy actually has thought about how I got here and is challenging me on who I am. I'm not being a jerk. I mean, you understand what I'm saying? So, and then we had he was just kind of more fascinated with how, and then almost looking at his own life. He's like, well, I remember this moment. Like I was 5 years in and I was working for this company and I was so impressed by the company doing things that I thought was interesting. And I was just sitting over as a consultant, putting together PowerPoints. I'm like, yeah. So what started clicking? And why did you do that? And how did you get to here? How did you find your founder? How did you guys create this company? And how did we get here? And so when we start to have those conversations, and when I can have a conversation that's like that, and where they open up and they explain their motivation and I can understand it and I can see it, then we can start digging into what I hope is a incredible technology company that we can take to the next level. If I can't get that out of the person, it's no criticism of that person. It's just going to be more of a difficult working relationship.
We're not in that.
Right. Or you're hiding something, or you're actually bullshitting. You're actually making this stuff up. And you can feel that. Because when you start a company and you have 7 customers or 3 customers and they're each paying you $5,000 a month, what do you really know?
Right.
Like, I have to call those customers. Those customers have to tell me they love you. If they don't tell me they love you, your first 3 customers, then we have no chance of doing it. There's just no chance. Because that tells me that you, the founder, are creating the solution in your mind that your customer needs. Not creating the solution that the customer needs in their mind. See?
Mm-hmm.
And we see that a lot. And we understand that's also a normal track. A lot of founders start as like, this should be happening. And they go out and they create tech, and they don't really have the back and forth on the potential customer base.
When it comes to...
You following, Sean?
Yeah. Oh, no, I'm tracking. I'm tracking. Yeah, well, because anyone can get a first 1 or 2 or 3 customers, and you're looking to build something sustainable over a decade or even longer. And so if you're not having that open conversation, then you're not evolving the product to fit their needs. And it just shows that they're not really thinking about the end user. They're thinking about like what they can build.
Exactly.
Totally.
Exactly. How do I build a company that, snakes through?
What do you feel like you notice about the industry that maybe others don't? And I know that you're not, like the person's like, oh, I'm the best at all of these. But like when you think about your own role within Bonfire, like what's the magic that you feel you bring? What's your genius, if you will, when you think about like all the work that you do within, the investing world?
I wouldn't call it genius, so let's be careful there.
Okay. My words.
What I found out to be exceptionally true over the last 2 or 3 years was, and particularly in our fundraising process, but also in market analysis and things like that, is I have a long capital markets background. And I don't have an operator background. So I don't know how to operate a company. I've seen it done over and over and over. I can learn things from those founders over and over and try to apply it to new companies, et cetera. But my capital markets experience is unique in the venture capital world. I'm not saying there aren't other venture capitals, people that have unique capital market experience, but there's not a lot. And so in my conversations with LPs in this last round, was a lot of conversation about how capital markets works, meaning how do interest rates and inflation actually affect the world? Why is that important? Because inflation and interest rates affect M&A. Why is that important? Because M&A affects venture capital. It just is a circular motion. So if private equity companies who have more money than, in some funds than all of venture capital combined, they are the engine that keeps the M&A world going around. They do LBOs, leverage buyouts, leverage in order to borrow money. They borrow money from lots of different institutions. But if they have to borrow money that costs more to borrow, i.e. interest rates are high,
Mm-hmm.
they pay less. They just pay less because they have an equity check they have to write. Follow me? So if they're going to write a $100 million deal and they borrow 50 million, okay, and they're paying 3.5%, they can pay a certain price. If they have to borrow 50 million and pay 7%, they just lower the price. And so that has put a damper on the M&A that's driving private equity. Okay, fine. Let's put that aside for a second. Why is that important? Because 98% of all venture capital exits are from M&A. Doesn't mean they're all going to PE. They're going to strategics. They're going to PE. They're going to competitors. They're going to peers, etc. But they have to be in that circle in order to work. And again, if interest rates are high, lower PE, lower exits in the IPO market, which has proven out to be true. There's obviously we have some huge wins, but there's still not a lot of IPOs happening in a grand scale, all because the capital markets in general is still in disarray. So when you start to talk about how that affects the M&A markets, because all anybody cares about in LP land is exits. It's all we all should care about is exits. And exits, as we all heard, was really bad in 22, 23, and 24. And I think it's directly tied to interest rates and, of course, economy and stuff like that. But they're all tied together. So when I have this conversation with large LP that has, 20 billion of assets, that's a different conversation. They listen. Not that they didn't know these things themselves, but we can have a conversation, which I think is harder.
You become like the startup in that environment. Like they're getting to middle ground with you. They see that you understand beneath the curtain, which then builds that trust to then say, hey, is this the right opportunity?
Something like that. I think that's right. Now, the flavor of VC has changed dramatically again, right? We have had...
Give us the precursor, like, what would you say was like COVID, post-COVID, and then today? Or like when you say that it's changed, like what are the kind of chunks of time?
Just to make it a shorter conversation, let's call it pre-COVID VC and pre-2016 VC was a different animal prior up to 2016. A lot fewer firms, a lot less capital, much more of a craft business. You knew and still know, you knew who the top 10 VCs ever were, the Kleiners, the Sequoias, the benchmarks. They'd been around since the 80s, that kind of brand. And it was still what I would call an alternative asset class. In many ways, when you look at an LP, the diversifications, they would put private equity and venture capital in one bucket, kind of private. And it most likely was called private equity. And you'd have to dig in there. Let's say they had $1 billion committed each year to private equity. You'd have to look in there and see 100 million is VC, right? But it'd be in one bucket. I think over time, people have started to separate the two buckets, meaning there's PE and there's VC because they're supposed to be different return objectives. And so up to 2016, with the advent and the acceptance and the adoption of cloud and mobile completely, we've talked about cloud and mobile before, that just exploded technology. We now have trillion-dollar companies. All these things are happening, and that started back then. And as that grew, the opportunity for venture capital dollars to go to work grew, and the more and more venture capital firms were launched. And the name brands started raising more capital. I don't even remember what it was, but I remember when Andreessen Horowitz raised like a $400 million debut fund. I'm like, wow, right? They're about to raise a $20 billion fund. That's less than 10 years later. Just incredible growth. So they raised that $400 million fund. And then the markets were like this. There was a lot of exits in 17, 18, 19. There were a lot of new funds starting, 30, 40, 50 million. The seed and pre-seed, the area I'm in, became very hot because people wanted to get in early. And when you have less capital, that's where you have to start. If you only have a $50 million fund, you don't start in the C rounds. You'll never be able to play. So you have to start in smaller. That's why we started smaller. And so that market grew into 2020, and we were quite buoyant coming into 2020. And then, of course, COVID happened. And COVID, COVID had a moment where markets and everything was like, Jesus, what do we do? As a venture capital, as a private equity investor, as a private investor, as a capital markets investor, everybody's like, what do we do? And then we had this crazy explosion, driven by capital in the markets, and maybe the world's going to be okay, and maybe we can all live by Zoom. And you can see, what happened. So then 21 was just insane in terms of exits and valuations. It wasn't exits necessarily, if I recall, from M&A IPOs. There were a few, but it was more exits, SPACs, and there was a whole bunch of stuff going on at the same time. But there were a lot of secondaries, huge rounds being done at crazy valuations, the open seas of the world, and a lot of Web3, and everything was just off the charts. And then that all went away, just disappeared.
2022.
And then for 22 and 23 were pretty quiet. And people were licking their wounds and trying to figure out what to do, and talking prior portfolio companies that had raised at crazy valuations at low revenue numbers. And so now what are we doing? It was like a little bit of a real reflective period. There wasn't a lot of growth. And then OpenAI, I think it was November 23. And look, venture capital is always looking for a story, always looking for something to jump onto. It's whether it's frontier tech or space or Mars,
Web3 or
climate tech or Web3. By the way, it's great to be in VC world, right? I'm not complaining about it. It's like we get to at least have this conversation. I was with a friend who I grew up with in Colorado. He's not in the business, but he has also no real care. He doesn't really care or understand what's happening in tech. Because he just doesn't, and so that's not a negative. It's just like, I feel fortunate that I'm at least in on the conversation, or at least I'm getting educated and I'm reading and I'm part of the discussion. So the 22, 23, that just ended for a lot of VCs, or they're, haven't been able to come back. And meanwhile, the AI starts, and that just, as we all know, exploded and has continued to explode. And a lot of the big names were getting back into the MMLs. What do we call them?
LLMs.
LLMs, Jesus.
Yeah.
Edit that. I sound like an idiot. You can keep it in, but so tired of the acronyms, I don't care. The LLMs, and there was like this infrastructure game, and everybody got back involved in the infrastructure, and that was private equity and big funds and little funds, and everybody's getting, and then people like us who can't invest in infrastructure because it's just too capital intensive, waiting and starting to evaluate what's going to happen for opportunities with us, which has become, of course, the application layer. So venture moves on to the next more than anybody. And I don't know how it actually happens, because I can tell you that the 1,000 unicorns that we all labeled in 2021, 950 of them are still not there. And we're just like, okay, forget all those companies in 21 and 20. We're gone. We're now talking about AI. And if you were able to survive as a VC, both on prior exits or exits that you made in 2021 or current portfolio, like you were able to show that you still survived and did well, or survived that period, you are still in the game. If you aren't able to show that, you're out of the game, understandably. And so it's just like, I'm making fun of our own community. We for 21 is like, what happened? We don't care anymore. Even though a lot of us have companies in our portfolios that were financed then, because it's all golden sky right now. And to be honest, I fear that type of, this boom bust mentality, and we are booming right now.
That's what I wanted to ask. Well, but before I ask about...
Can I answer your question?
Yeah, definitely. And just to elaborate a little bit, I'm curious, like for us in 2022, Coefficient Labs started in 2015, and for basically all the way through 22, we've never had a headwinds. We've just been growing the company. It's been fantastic. And then 22 is the first time that it was like, holy shit, like we need to adjust. We're having clients that aren't renewing. They don't have funding coming in. And it felt like that war room mentality of like, we got to kind of come up with a new product or a new something. How do you respond? How does a VC respond when you're talking about licking your wounds? Like, how do you come together to get through a tough time like that? And did you and Bonfire have any sort of internal strategy or meeting that was like, hey guys, like I see the writing on the wall. I even have a memory of you in particular, Mark, where I was saying, something to the effect of like, I was talking to my dad. This is back in 22 when we had our podcast. And it was, I said to my dad, like, I'm hearing that there's going to be this recession. And I was talking to you and you're like, oh, you think it's bad now? Just wait until we get to the end of the year. Wait until we get into 2023. Like, it's going to get much worse. And for us, it felt like, oh, we need to come up with a new product. We need to come up with a new service. What was sort of the mentality like for you guys back then? And how did you even think about weathering the storm, so to speak?
Well, we had a lot of team conversations. We had, literal offsites and things like that. We had a LP meeting, an annual. We have it every other year. So this was the April 22 LP meeting, and there was still a lot of positive. Like, it was still buoyant.
Mm-hmm.
When we had that meeting, we had like our top 6 companies presenting, and top 6 meaning whether they were growing the fastest or they had raised the highest valuation.
Yeah,
and I think that was memorable. It was up in Santa Barbara, and it was memorable because there's a lot of connections, a lot of people talking, dinners and stuff like that, where you could have an open conversation like, yeah, what we're reporting now is past. And of course we want to be positive. And I didn't say this, but as in hindsight, if I think about the 6 companies that presented, 3 are in big trouble and 3 are still doing well. But, at one point, those 3 were stars.
Mm-hmm.
And that can happen, and that's going to happen again, right? You can be a star and then not a star in someone's portfolio in a very quick way, and the other way around. But that was April 22. We had an offsite in September 22.
Yeah, that's when it started with like, what was it, Silicon Valley Bank, or like somewhere around that time?
That was 23. That was
was that 23?
That was Upfront Summit 23, so that was March. I want to say it was March 23.
Got it. Okay.
But yes, I mean,
right in that area.
And September 22, we talked about where we were with prior portfolios, which companies were good businesses versus were good only because of taking advantage of the current market, environment. Mm-hmm. We tried to get agreement on, well, I know that's your company and that at one point was your favorite company, but we're not going to give them any more money. So we need to have that. We need to have early conversations. We always try to be very upfront with our founders, and so we tried to segregate and identify winners and losers in the portfolio.
Mm-hmm.
And then we actually made a scorecard of all the characteristics we try to look at, just a summary of characteristics. I think it was 11 or 13 characteristics we look at when we look at a company. And then when we made the investment, how many of those were check marked. And we determined that if anything, any of these companies had 3 or more non-check marks, X's, they were all doing poorly. I did all this because I like the
visual.
I like to talk intuition, but I also like to back it up with some information.
Mm-hmm.
And so I was like, well, so this suggests that every company we run through, we should do a report card on these. And if there's more than 2, it's on the risk curve, and we have to really look at it. So we started to look at those types of metrics and things like that around the founders, and used that for kind of the next 2 years. Half of 22 was the first investment for Fund 3, which was our $170 million fund, was July 22. And we made 6 investments that year in that fund. And they were all characteristics of better traction, more experienced founders. Co-founder was tech CTO, tech lead, certain things that we were on our check marks. And because the market was in what I would say disarray, and particularly in the seed market, so a lot of seed investors, we felt, again, we were very lucky. We raised Fund 3 in January 22. We didn't turn it on until July 23.
Wow.
So we raised it off the 21, and then we didn't turn it on until 23. And so then we started making these investments. So we had capital, and we were seeing opportunities where we were able to get into deals earlier, get into deals we may not have been able to get into because of valuations that come way down. Mm-hmm. They had more traction. There was fewer seed lead investors out there. And so that first cohort of, and you see it in the numbers we just put out, 100% of raised days, A huge number, 100% of fund three, which is 32 companies, still going. I don't know if that's a win. I mean, some of those companies will go out of business. That's life. I don't know which ones yet, but that's life. You can't just say, wow, we're going to have a 100% hit rate. That's just not going to happen. But we actually sat down and went through criteria and things we wanted to focus on. We are actively doing that now, again, because of what's happening in the market. And what's happening in the market is incredible valuations, incredible expectations on valuations, very low, maybe a lot of pre-product, pre-idea, pre everything, but people raising a lot of money. YC has really taken over some dominance on those early stage companies. They've set the price range now for the market, and it starts in San Francisco. And of course, there's a little discount as you go outside the market, but we're back to what I would characterize as 2021 type mentality, where at any price, I got to win this deal. And while I understand that in the later stage investor environment, meaning ABCs a little bit, where there's more traction, there's more information, you can do that bet. It doesn't really matter if you invest at 70 pre or 90 pre. At that point, I get all that stuff. It does matter when you invest at 15 versus 30 pre in a seed environment or a pre-seed environment where there's very little traction. And that company can be out of business in a very short period of time. So that market has been, it's overheated right now. It's overheated. So we're always constantly saying, how do we make sure what the investments we're making now are ones that will sustain? And I don't have the answer. If I knew that 100% of the time, you know the answer. And so we have to just we have a quarterly offsite. We talk all the time, but we have a quarterly offsite. And there's so much noise and information, and we're all listening to our own noise and information. We all listen to basic podcasts, certain things like that. And then you have a couple others. And, every week on Slack, somebody goes, hey, I just listened to this podcast from Sean and then this. And you're like, well, is that? I mean, what do we do to change? Because there's just too much information, and you listen to podcasts about other VCs and how they're building their businesses. We have always tried to and continue to say, we invest in seed stage founders in software companies for B2B focus. We are just trying to get better at that. We're only trying to get great at that. We're not trying to do pre-seed and A's and B's. We're not doing growth rounds. We're not doing climate tech one year and Web3 the next year and something else the next. That is fine for everybody else. We're just really focused and trying to be really known as a great seed investor. And that has also helped us with our fundraising.
Being focused, selling one
LPs, we're very look, we know what we're going to get from Bonfire. We know what Bonfire stands for. I think a lot of seed funds have difficulty with that explanation, with that, and really knowing what you stand for.
I think it's just hard at an individual level. I think most founders, most startups, most people are sort of they're getting their sources. Oh my gosh, maybe we should be going in this direction. Maybe. And so to be able to, rest on your conviction of staying in one lane, it definitely, whatever you're selling, being that kind of person that focuses is much, easier to digest.
Now to take that analogy further,
yeah,
we're trying to drive, if you want to use the lane thing, we're trying to drive the best car. You can't just say, we're not going to change, we're not going to do anything. That's not what we're saying. We're trying to be the best in our lane. And instead of saying we're not changing, we're just going to keep it. I think that's a recipe for disaster as well. So to use the analogy, I'm getting the best wheels, we're cleaning the spokes. I mean, we are, doing everything we can to that car.
Now, last time we talked in 22, Web3 was kind of popping up. Yeah, right. What did you even say? And so I'm curious, do you feel like this is it's apples to oranges, the AI and what's happening right now, and the breadth it has on companies and your own investment thesis? Is it just completely different, or is there that part of that boom bust does it feel like it's very similar and it's just the next chapter of the next version of Web3? It personally, meaning like when you sit in
I have
the
a couple answers that I'll try to then combine into the final answer, one answer. Using my mobile and cloud analogy, okay, let's call mobile really started, of course, with the day the iPhone came out. Even though there were flip
shout out BlackBerry.
I love BlackBerry. I still have one on my desk just so I can look at it. Try to play Brick Breaker. And so mobile really took off at that point, and a lot of people built companies that were mobile or to focus on mobile, or there were VCs that said we invest in mobile. Totally get that, and that worked for a while. Then it became silly because if you weren't trying to build something for mobile, what are you doing?
Mm-hmm. Mm-hmm.
Okay, now take the next analogy, which is cloud. Mm-hmm. Cloud, I would have said, started in 2009, 2010, where people started realizing they needed to move their assets to the cloud. They need to move their information to the cloud. They need to have access to everything in the cloud. Even back then, if you ask people I know, they're like, I understand what the cloud is. They're looking up, but there was a lot of movement on the cloud that drove an incredible amount of value and innovation in the software world that led to the SaaS environment, et cetera, the Salesforce of the world. Salesforce was around before that.
Yeah, and verticalization of SaaS.
Exactly. Mm-hmm. And then you had VCs that were saying, we're investing in the cloud. As a matter of fact, Double M Capital's first deck says we're investing in mobile and cloud. Ridiculous for me to say that. I got away with it, but it's ridiculous for me to say that. You don't invest in mobile and the cloud. You invest in companies that are mobile enabled and use the cloud. Okay, by 2016, 17, 18, you can't use those as separators. They're not different. Everybody is in the cloud. And if you're not in the cloud, you're moving to the cloud. Everybody is on mobile. And if you're not on mobile, you're moving to mobile. So you no longer could say we're investing in mobile and cloud. That's just stupid. AI. For a while there, AI came out and you have AI funds. We're investing in AI. We're only investing in AI companies. We invest in companies that utilize AI. Great. And for a while there, I think that was differentiators. Mm-hmm. There was some differentiation because companies were still stuck investing in manufacturing or hardware or just SaaS or something like that. Yes, we're investing in AI. I 100% believe in a year or less or more, let's just call it within 2 years, if you come out and say, I'm going to invest in AI, that doesn't make any sense. Mm-hmm. Because if you're investing in a company that is not using AI, what is that company doing? Why would you invest in that company? Mm-hmm. Even in a manufacturing or non-software type company, AI is going to be ubiquitous, whether it's on the internal operations side, using it for education or research,
streamlining
or information, or operational streamlining, or it's being used for engaging with your customers. One of those two you have to be using it for, and hopefully both. And pretty soon you won't be saying I'm investing in AI companies. I'm investing in a company. That's where we're going to go back to we invest in seed stage software companies. Of course it's mobile. Of course it's in the cloud. And of course they use AI. So we don't differentiate. That's, I know where we're going.
Because focusing just on AI is like the most surface level part of it. It's not focusing on the problem, the solution, the customer, that like what issue they have, and then how AI can, AI is just the tool to help them.
Yeah. Using these past environments. Yes. Is AI maybe the biggest thing that's ever hit the tech world? Probably, for sure. And
you feel it internally.
It just, it is. Like, every day we're all using AI in some sort of way. I think we're all worried about AI in many ways. I have 2 children in college. I'm trying to see how that affects their
last time your son was only 16.
So, but I'm also benefiting from AI, and I have to find the right balance. But I think over time, and there will be, unfortunately, a lot of haves and have-nots in terms of who uses AI and who doesn't. Mm-hmm. But on a company basis, investing in a company, if you're not using AI, you're not in the cloud, you're not mobile, what are you doing? Mm-hmm. Mm-hmm. And so, yes, is this one of the biggest changes in technology and infrastructure? For sure. But what's so interesting is these are happening really quickly. In 25 years, well, you'd have to go back to 94. So let's call it 30 years from Netscape to today. We've had the internet, We've had mobile, we've had cloud, now we have AI. Massive changes in only 25 years. And you think about the world before,
Yeah.
nothing of that happened until that world before, So I think
Yeah, but even in
it's just accelerating faster.
yeah, but even in the last year, like the speed at which AI, and I'm sure it's almost a daily basis where you talk to a team and you're like, damn, I didn't know it could do that, or like, wow, that just saved like X percentage of efficiency, and like I'm sure it's still shocking sometimes to see how innovative people can use it.
Well, you wonder how everybody like. I can't spend all day trying to learn about AI or use different tools. So it's just we have a life, we're busy and things like that. So you're worried a little bit, like you're falling behind. You're going to miss out some things.
Yeah.
We have really implemented AI inside of Bonfire to the extent where whether it's outbound, whether it's inbound information that immediately gets reviewed, transcribed, and then put into a format that gets into what's called a early stage format memo that gets sent to everybody. That memo is then a living document that gets updated by AI. Like we are attempting to automate as much of the process part of venture capital as we can, so that we can get to spend time more on the real quality analysis, which is talking to customers, talking to the founder, talking to customers, not just doing AI research stuff. So if we can get down to those final decisions, rather than spending time me writing a memo or something like that. So we're moving on. Is that cool? Yes. Is that table stakes? Yes.
Already.
Yes. And we don't say, hey, we got the Bonfire engine, we're smarter than ever. That's not a thing. We're just trying to make sure we're there in the game. It's pretty cool. It's called Bonnie.
But this is a little internal product for you guys.
Everything comes in, we can talk to it, ask questions to it, add to it.
Wow. Yeah. You if you think about being able to port back the data of all of your I mean, over time, you could create a huge, opportunity. Like, which of my portfolio companies share similar characteristics to what, like, you could just start to get so deep into it. What do you think are the biggest challenges that VCs are facing today, or like over the next year? Like when you think about what this next year or two, you're mentoring a new, solo GP, and you're saying, hey, like, you got to be aware of this. Like, what do you think are the challenges that face VCs?
Differentiation.
Differentiation.
Because like I just said, we're building this AI engine just to make table stakes. There's a lot of basics, right? So you still have to get back to, and I have a theory on this, which is eventually, let's just, for discussion purposes, use a year from today, everybody will be using 95% of their investment process will be AI managed or driven. So we'll all be back to the same. And then you have to differentiate. 5 years ago, I had to differentiate what Bonfire did differently than other. 12 years ago, I had to differentiate what Mull Capital did different than everybody else. And so okay, we have money and we focus on it. Okay, so does everybody else. So do they. They have a lot. And now in today's environment, there's so much money in these larger VC firms. You've been reading a lot about this, right? Like last year, I think, 70% of the capital raised in all VC landia was in 10 VC firms. Okay. So there's an incredible amount of capital, and that is competitive in itself, because if the firm that has that capital makes a commitment to making these investments, they're going to beat me every time, unless the founder sees something or believes something in me over that other firm and is willing to take a lower price, because I'm not going to win on price. And I'm not unique either. This is a existential moment, I think, for VCs that are smaller and trying to figure out what lane they can continue to play in, when the big funds are coming lower and lower into these and saying, look, we're just trying to buy bets. And they're not good bets. I'm just saying I have a $6 billion fund. If I invest in this seed company at 22 million instead of the 16 you offer, I don't care. You do, because you have the $245 million fund you're trying. I don't. And so I think that's a big issue that we all have. And the second piece is, look, SF is taken over again, right? It's incredible what's
in what way, or help me understand.
It's the conversation. we're talking about New York a lot, but SF and New York have regained the mind share of all founders again. And that was certainly the case in 2000 in 1995, in 2003, in 2015, in 2021. It was all San Francisco. I get it. There was New York and London, little pieces of LA, and we were all getting our fair share. But I think the fair share has been reduced because of the hype and the interest and the money and the desire to be back in Silicon Valley.
Do you think that, I was, years ago sitting with a mentor at lunch, we were having sushi, and I was telling him about, who I wanted to hire, and, I'm not going to be able to afford this type of person. And he took these two chopsticks and he snapped one of the chopsticks, the tip off. And he basically said, like, there's always going to be the Andreessens or the Sequoia, like there's always going to be the people that have more money. You need to figure out, what is this little piece of the stick? Like, what makes you different or what makes you stand out? What do you think?
I love that guy. Do I know him?
Todd Emus.
From where?
2020. He was at a Mucker way back in the day.
That's great.
He also has a famous.
I'm gonna start carrying chopsticks around, and just breaking them in
snap,
front of the
snap off the top. And so what do you think the VC evolves into with the small chopstick? Like, what are the things that you think are going to make VCs stand out when these mega funds continue to get bigger and bigger? How does the smaller fund, how does even the bonfires that have been around, like, what do you think is going to equate to value to startups over this next 3, 5, 6 years?
Well, I think it still comes down to the interpersonal relationship with the investor and the founder, and that investor has to be unique and different. I would imagine a quality founder who is pinged by a unknown venture capitalist at a large firm. So let's just take A16Z, who's grown dramatically. I think they have 1,000 people now. If a VP from A16Z reaches out to you, you take the call or you take the conversation. Why? Because this is A16Z. Now you're talking to this founder, this partner, or it may not even be a partner, and you're trying to learn about that person. That person they got the call because of the name, but now they have to differentiate. Now, the way I have to win is if I reach out to that same founder and say it's Mark Mullen from Bonfire, I hope my reputation precedes me a little bit. And why does he take that call? Not because it necessarily says Bonfire, because it says Mark Mullen. And then I have to convince them that Mark Mullen and the capital, dollars are dollars. Mark Mullen is going to be more impactful and more helpful and more focused on me as a founder than A16Z in this stage. Look, I love A16Z to come on after me. Mm-hmm. But in this stage, I think I'm going to get more out of Mark or Jim or Jen or whoever at our firm. We have to make that happen. The only way we can make that happen is get them into a conversation that has them talk to our founders that we've invested in before. And then they have to talk to our founders, and our founders have to say, look, Jim is always available, always helpful, totally knows how to build a company, totally calm. Those are the guys you definitely want in your corner. And not only Jim, but the whole team. I don't know if you've met the whole Bonfire team. Mm-hmm. So many different resources. They're really great people. They treat people right. And they're really good at getting you to that next round. If I were you, I would go with Bonfire and keep the other guys warm. That's the only way I can win those deals.
Yeah, it's interesting. It seems like you guys are thinking of yourselves almost more like a product team. It's like you, Bonfire's the product and capital is one part of it, but now potentially being able to utilize some of the tools you're building with AI or being able to use your networks across, like all the different industries you have. It's really interesting to see you guys like evolve into that sort of almost like product-led mentality. Do you think of it that way or not really?
That's a good way to summarize it. I think that I'll give you an example of a deal that I lost this year. I was a founder that is LA based. I got to know a year and a half ago before they were ever raising. It came from a very good relationship of mine who could speak very highly about me and Bonfire, et cetera. I worked with him on a continuous basis talking about how he's building his company, the stage he was in, decisions he was making, even though he wasn't raising money. Always preparing for trying to be ahead of that time where he decided to raise money. As he started getting closer to that period, I brought him into the team, started spending more time with the team, started talking to his customers. He decided to raise. We gave him a term sheet. But by that time, he was starting to talk to other investors, and he was, I believe, totally sincere in saying, I really want you guys, this is exactly what I was looking for in a partner, someone I can trust and I've built a relationship with. All that shit that I like to do, right? And of course, at the end, somebody outbid us by a lot, not like 5 million. We offered 5 at 25 pre. They took 10 at 40 pre. And I mean, I remember having a conversation like, I'm not doing that. It wasn't like hey, so at some point there is going to be, and I understand it, the founders who will just take the best value. And I don't have a problem with it. That's life. They take the best deal. And in that case, you look at that, I don't have a problem with that because I don't think the VC is going to matter to this guy at this point. People they went with don't matter. That founder has the gumption to build this company. And so I think that he may have made the right decision because he's getting diluted less, taking money he really doesn't care about, even though he was giving me, smoke.
Yeah.
You're great. I want to partner with you. Didn't matter at the end. Didn't matter. And I think that's back to your earlier question, what a lot of us are facing. You have to be able to win those deals based on something other than money.
Earlier this year, we had this, horrible tragedy in the Palisades in Altadena in California. And, we actually had this episode scheduled for you during the week of the fires. And the day of the podcast, you sent us an email and we're like, hey guys, the fires are getting really bad. I don't know what's going to end up happening. And it was, days, a week later or something, and we found out that your house had burned down. And I wanted to take a little bit of time maybe for you to like bring people that weren't, in that world, or like whether they're in California or out of California, like what was it like for you during those days? And, how did you have to, evolve through that? Like, obviously you have so much of your personal family, your memories, everything's wrapped in. So can you talk to us a little bit about what that week was like for you and what the aftermath, led to?
I guess so. A lot of it's revisionist history now, or thinking what happened. My wife is born and raised in the Palisades. Her mother has been there for 80 years. So, long time Palisades relationships and families. She went to all the schools there. She went to Pali High. So we moved here from New York City. Where are we going to move to? Pacific Palisades. I didn't even know what it was. So I've just been along for the great ride that it was. And we've been in our house for 18 years. And, my kids grew up there. They're now, as I mentioned, both in college, but they grew up their whole lives there, basically. And so when the fire happened, we didn't really know until Wednesday morning. If you remember, the fire was on a Tuesday. We were never evacuated. Where my house was is right off the cliff, by the cliff on the ocean side. And sadly, I made the comment that afternoon, was like, for this fire to get to my house, it has to burn the whole Palisades, because I'm like at the end. And damn if it didn't burn the whole Palisades. Like, it's insane. And because of the winds and because there was no helicopters and just the disaster that was going on, there was no news. There's no newscaster in the Palisades and here's what's happening. No, there was nothing. So when we finally got to a hotel that night, after we had to take care of my in-laws, another long story first, when we finally got to the hotel that night, really kind of exhausted, and somehow fell asleep probably for 3 or 4 hours. And then even then, when you wake up, you can't get information. Like, I didn't know if our house burned down. And the only way I knew is that I did have a neighbor who's one of those guys that you know,
He's there.
he's got an arsenal in his house. I think I could just see him on his bike that day riding back into the Palisades with probably 2 guns and a vest and his house, which was about 5 houses from mine. He was showing a video of it, which was completely burned down, and put it on a WhatsApp channel that had been started the night before with a whole bunch of neighbors. So WhatsApp was interesting. Like what's this communication from that perspective? There's a lot of communication, a lot of I don't knows. And then I just texted him separately. I said, can you go check my house? He goes, yeah. So he drives up, and 2 minutes later, he sends me a video of my house completely burned to the ground. That was the first time we knew. Not that I wasn't not expecting that. I will say when I went to bed, I was hopeful that, of course, the fire department's going to stop this stuff or something's going to happen, right? I was hopeful. And so that happened the next day. And at that point, you really had no choice. It wasn't. My wife and I are very fortunate. We're very happy with our relationship with our kids. You know, we get to live in the Palisades. I get to work. I mean, everything. We feel very fortunate as people, and we're basically optimistic people in general. So I would never want to compare my reaction to these fires to anybody else or vice versa. Like everybody has their own things going on. We feel very fortunate because I had a senior in high school whose school was not impacted, and my daughter wasn't even in town. To the people whose kids were 6 and 9 and they go to elementary school in Palisades, which had just burned down, or they go to a church or synagogue in Palisades that just burned down, or their grocery store had just burned down. So we felt like we're a little bit ahead of that game, where we don't have to. We were just more trying to find a place to live because we knew that was going to be a disaster. And so you didn't have I remember texting a friend. I said another friend whose house burned down in the Palisades, and I said we were built for this. Like we have no choice but to take over the situation. Meaning, you know, you got to stand up. You got to take care of things. You got to take care of the family. You got to do as much as you can. Business-wise, didn't matter. We got Bonfire. Everybody was taking care of that. It was like there was nothing that was. Ironically, we had one of our largest LP in the office that day doing final due diligence for Fund 4. Final due diligence. You could see the smoke from my office.
Yeah.
Right?
Yeah.
I sent you that
I know
picture.
that office well. Yeah.
You could see the smoke, and at that point, it was like 11 in the morning. And again, the wind was going out. You figured it was going to be taken care of. There was no evacuation notice. So I was in the meeting answering questions. Now I was kind of like, eventually people are like, I think I probably got to go home. You know, that's how it went. So long answer is very impactful to different people for different reasons. I will say it has been a shit show over there. As you can expect, the city government has not stepped up as they were supposed to, in my opinion. Insurance companies are not paying out like they were supposed to. And it's just a really terrible situation.
One of the great things, I don't know if it's necessarily a great thing, but you know, you've lived such a full life. You've had so many chapters that you kind of go through these phases where, you know, things are great, something happens, things are great, something happens. What lesson did you take away? Like in your moment of silence from just going through it, having time to get over the immediacy, is there a takeaway or a learning that you had from that experience that, you know, maybe someone listening that is having their own traumatic event? It doesn't have to be a fire, but it's like you had everything perfect and then in one day it wasn't. Is there anything you took away that someone else could learn from it?
It's a very quick summary. It's like a lot of shit doesn't matter. That shit just doesn't matter. You got your family. If you got the family, if that's what's most important to you, you got relationships with what matters here. You know, we lost everything because we didn't evacuate anything. So things like a wedding album, every photo ever. But today's world, we have digital. But, you know, prior to digital, all those photos are gone. Silly stuff, which we all love, which is my concert tickets from the 70s. My Rolling Stones concert ticket from 1978 in Boulder. Okay, Guess what? I kept that in a box for 40 years. And it turns out it doesn't matter to anybody but me because it's a memory, even though I never looked at it. So a lot of stuff at the end of the day doesn't matter if you have those things. I don't want to say that everybody has those things to rely on. And so I think that it did crystallize as well. And I don't think this is was the objective or the outcome. You shrink your family and friends. Not really family, you shrink your friend group. Where you realize in your life over time that a lot of relationships you have can be transactional in nature. You don't really get to know each other very well. That's life. We all have transactions with relationships. You and I have known each other for a long time. We get along very well. I don't know you very well. Mm-hmm. Right?
Yeah.
Okay. That's life. And so what was important was focusing back on the relationships that matter and less on transactional. And for me personally, it was like a lot of shutting off people that were taking rather than giving. And that's probably a time frame in your life. It's very hard for people to do, unless some sort of event happens like this, like it's an excuse. And I joke, like I cut a lot of mids out, and not to be mean. It's just like
Focus on what matters most.
I can't have this kind of, I really need to do these things. So it's an obvious thing to say that a lot of shit we worry about doesn't matter. But again, I only want to say it about myself. So I don't want to impose that on anybody else because everybody has their own things going on.
Well, Mark, thank you for sharing the story and your perspective on it. And I think that, oftentimes we get wrapped up in thinking everything matters so much. And it takes these sorts of moments to realize, no, I've got my family, I've got my dog, I've got my friends, I've got my parents. And so I think that's a really great perspective for people to hear. And again, I appreciate you so much for coming on the show. As we wrap up the podcast, I'm curious, is there any quote that resonates with you that you live your life by, or a quote that comes to your mind that just has kind of played a role in your career, in your personal life? Any quote come to mind that you really love?
I always go back to one that I've written before, which was Bill's. If you haven't decided to bet on yourself, you should try. You'll never know if you don't. Right? So I use that with founders too.
Mark, it's been an absolute pleasure having you back in HQ. Absolutely love having you guys, biggest Bonfire supporters. And yeah, I can't wait to do it again in a couple years and we can look back on this and see what the hell happens.
We'll be having something to talk about in 2 years, I hope.
All right, guys, from everyone listening at home, I'm your host, Sean Goldfaden from Coefficient Labs, and this is Demo Day. Peace, guys.